All right, so we have to talk about all the bailout nonsense and all what's going on with SVB and actually work through what all this actually means. I mean, not the YouTube narrative, not the media narrative, not all the Twitter narrative, all the other garbage that's out there. We need to just cut down to the facts and get to the truth of the matter. Now, I'm going to be upfront. This video is a little bit raw. I actually made it for my group yesterday, and it's one of those things to where it's so important, guys. I didn't want to keep it there. I wanted to share it with you, but it basically breaks all this down. So I'm going to bring that to you guys right now, and just make sure you click the like video and subscribe if you like information like this. And also, just so everybody knows, the March Madness sale is live for my private group. If you like having, 3 to 5, 6, I don't know, however many videos I'm on a roll this week making videos for my group. And you also get all my buy and sell alerts. You get my watch list with price targets. You get all 5 of the courses that you can take for completely free. Access to the Discord, hundreds of tutorials, all sorts of good stuff like that. And there is a secret project coming to the group, but I will not be able to keep the price this low when it goes live. So make sure you lock in your price today, where you get that price as long as you stay a member before that price actually goes up forever. So make sure you check out the pinned comment down there if you're interested. Okay, now just remember, guys, this video is a little bit raw. I try to pump these out as quick as possible for the group, and we just kind of set up the camera. I got my notes there, and I shoot and I go. So be a little bit easy on me, guys. They are raw by design. All right, guys, so as you guys can tell, there's a lot changing, a lot moving and such. So I figured before I got the day started here, I would jump on here, make a quick video for you guys, and kind of just work through each piece of what it's happening as close to real time as I can in regards to it all unfolding and such. You guys know I don't like to react. I'm not reacting to anything here. This is no big deal. I guess it is kind of a big deal. Anyways, I'll explain it here in a minute. But I don't want the YouTube narrative and the media narrative and everything else that's already been ridiculous the whole weekend. It's once again ridiculous this morning, just a handful of things that I checked and such. So it's kind of like, hey, all right, let's go back. Let's talk about what this, some people are calling it a bailout. It's not a bailout. It's not even close to the same thing. Different ballpark, different zip code. But nonetheless, that's what's going to get put out there and such. So I was kind of like, hey, let's just not deal with speculation or anything else like that. My own personal thought is I actually like exactly what they did. I'm a little bit surprised that there wasn't already something there to kind of facilitate this type of transaction. But there isn't. But now that there is, so let's walk through the statement, what was actually put out there, and then we can deal with those facts as they are right there. So I'll throw it up there on the screen for you guys so that way you can see it. But here's the actual statement that came down. Today we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. This step will ensure that the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. So that right there kind of tells you where the thought process is here. This is the Secretary of Treasury, Fed Chairman Powell and the FDIC Chairman Grunberg. I assume that's how you pronounce that. Obviously Treasury Secretary Yellen as well. All those folks right there coming together. This is what they're trying to do. It is simply to ensure public confidence in the banking system, so that way they can do what? They can, protect deposits, which is important, and provide access to credit to households and businesses, because that is absolutely 100% how the economy works. The United States and the world now is basically a debt-based economy. So when lending stops, that is how you have economies collapse. That's the bottom line at the bottom, at its core. No matter what situation you want to look at, whether it's, Venezuela falling, all these other things that happen, all these currency craziness that happens and such. Bottom line comes down to lending and what lending facilities are out there to continue to conduct business and to continue to make the economy turn. That's how all this works. So that right there kind of tells you what they're focused on and what they're looking at. After receiving a recommendation from the boards of the FDIC and the Federal Reserve and consulting with the President, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all their money starting Monday, March 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayers. And that's very, very important wording there. Remember, this is a credit facility. This is a loan to that bank in order to move their obligations forward and to continue to pay the bills per se. So we'll talk about that specifically and how that happens here in just a second, guys. We'll walk through exactly how this doesn't actually affect tax holders or taxpayers at all. We are also announcing a similar systemic risk exception for Signature Bank, New York, New York, which was closed today by its state chartering authority. All depositors of this institution will be made whole, as with the resolution of Silicon Valley Bank. No losses will be borne by the taxpayer. Shareholders and certain unsecured debt holders will not be protected. Senior management will also be removed. So that's two key things right there. Shareholders, I mean, how could you ever protect shareholders, stock, investors? They're investors purely. It has nothing to do with the functioning of the bank or anything else. And obviously unsecured debt holders as well, because they have unsecured debt against that. It's considered the riskier form of debt if you're going to hold debt in that case. Senior management has also been removed. I absolutely agree with that. They were grossly incompetent, should have happened. That's very critical to any bailout type scenario, because during the financial crisis, those bankers wanted to keep their jobs. They wanted to bail out and they wanted to keep their jobs. As bold and as brash as that was, that's what they wanted. And in some cases, they got to. And in other cases, they got huge payouts when they did leave. It was a mess all the way around because the laws and everything else were not set up to make that happen. Now, fast forward, here we are, 15 years later, we're in this type situation. Management is immediately removed. There is no, golden whatever out the door. And there may even be some clawbacks and such in regards to pay, because legally there's teeth there to do it, whereas opposed to back in 2008, there was not. So very, very happy to see that they were immediately removed. There was no discussion. There was no, can the government do that? Can the government not do that? All those sort of things like that. Those rules did not exist back then. They exist now, and the government has the authority to do that, and that's good news for us. Any losses to the deposit insurance fund to support uninsured depositors will be recovered by special assessment on banks as required by law. And what that means is there's already assessments happening across all the banking industry. They all hate it. Doesn't matter. This was another consequence of the financial crisis and all that sort of stuff was, hey, you guys are also going to put money and be basically, it's not a tax, but essentially taxed on everything that comes in to put aside for a rainy day, for a bad scenario, for something of this nature cropping up out of nowhere and such. So that's kind of an additional backstop to keep it off the taxpayers' back and for it not to be a bailout of sorts. And that's why I giggle or I laugh whenever I hear bailout or this is the same in 2008 or anything. None of these things existed back then. And these were all put in place despite the fact that the bankers didn't like it. Nobody liked it because they had everybody, kind of by the skin of their teeth per se. They had to agree to these rules. They had to agree to play by these rules because of how bad it was back then. So this is another one of those deals where when you start hearing that narrative, this is another example of right there, hey, there's these special assessments that they can put on banks at any point in time, legally, by law, to cover, problems within the banking sector itself. So, part of that protection / hey, you get protected. However, you've got to contribute to this. So this is kind of where all that stuff kind of is put to the test for the first time since the financial crisis. And you see how this works to where there's multiple layers before it ever gets to taxpayers having to bail out anything. Finally, the Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. The U.S. banking system remains resilient and on solid foundation, in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. Those reforms, combined with today's actions, demonstrate our commitment to take the necessary steps to ensure that depositors' savings remain safe. So there it is right there. You guys can kind of see it there. The goal of all this is to make sure that the banking system's safe, make sure we don't have a run on the banks. And when we do, there's appropriate measures there to make sure you get yourself there. And what I mean by that is most banks, as a matter of fact, all banks, if everybody came in to withdraw all their money tomorrow, you couldn't get it. That's just the reality of it. There isn't the cash there because they lend it out, they do other things with it and such, and you just couldn't create enough quote unquote cash to cash everybody out all at the same time there. So we can argue whether that's right or wrong all day long. Doesn't matter. That ship sailed, 100 years ago. We're not there anymore. However, this is one of those deals. And in this particular scenario, you saw exactly what they were describing. In this scenario, SVB actually had the assets to pay all the deposits minus just a little bit of money. They needed a little bit of liquidation, which of course they could have gotten it through a loan, through something else in order to happen. But the problem was what they owned, gross negligence aside, that the management was just stupid for buying those particular types of bonds. Obviously you want to keep your treasury or your cash and your cash equivalents in some sort of a treasury instrument. However, buying good to maturity instruments during the lowest interest rate environment we've ever had in this country is just dumb. It's just stupid. Don't understand it. Doesn't make any sense. I don't care what any of the excuse makers say or anything else. It's dumb. So when you kind of see something like that happen and those sort of scenarios happen, what happened is they just could not quickly raise enough capital to handle all the outflows that were going. And basically it's called a bank run, right? And before you know it, oops, we got less, if we have to cash out all our investments right now, it's worth less than what it would be if it goes to maturity. Therefore, we're kind of upside down. And therefore you are insolvent. You're done at that stage. To me, a lot of times in these cases, it makes sense if there's actually assets there that can get you from point A to point B and save the bank to do that, to have a credit facility there to facilitate that. That's how a normal business would run, right? Hey, can't make our obligations by the end of the week. Do we go bankrupt, or do we reach out to our banking buddy over here and go, hey, we got money coming on Friday, but it's Monday and we got to pay the bill today. So can you, give us a short-term loan to get there? And then we'll pay, obviously, our bills now that are due today on Monday, and then we'll pay you guys back on Friday. That's actually how the repo market works and other markets that work along with the Fed and such in order to keep credit moving. They have credit lines with other banks and such. So that way, when these medium-term things happen, where they're short capital for one reason or another, they're able to draw onto these and to be able to pay those bills. But obviously the outflow of money was so large, it was more than they could accommodate. And add into addition to that, they just couldn't dump the assets that they had to pay those bills. And so you ended up with a bank run where the bank, the regulators essentially made the right call in taking it over quickly before more panic and before more everything else started to happen, and then created this new tool to make this credit facility happen. Now, I hear a lot of folks saying, hey, how is this different than 2008? How is this the same? I mean, should we have just provided these same sort of credit lines to those banks that went under back then, and maybe they wouldn't have gone under? Maybe they would have been able to stay afloat and we wouldn't have had the mass chaos that we had? And the answer is actually no, and here's the reason why. Back then, during that time when these things happened, one, this didn't exist. The Fed didn't have the authority. Nobody had the authority to do what they just did, to just create something out of thin air. Bang, here's a new product there. Maybe we'll talk about that later on. I'll study it a little bit more and we can talk about it in detail what this product actually is and the why and all that sort of stuff. But the reality is, it tells you right there in the rule, you've got to have assets that are actually worth something. And the problem was the banks went under not because they owned great assets and they just couldn't cash them out in time in order to do it. They owned assets that were worth zero. That was the big problem with the financial crisis and why that went down. Even if this was available, none of these banks could have drawn, none of those banks that failed could have drawn on that line of credit or on that government loan, been taken over, which is one of the conditions there, and then been able to have that line of credit to be able to continue the function of the bank because they didn't have any assets that were worth anything. Their assets were worth zero. Basically, a lot of them either owned bad loans that were going to default, which means they're worth zero, right? Or they kind of owned a bunch of synthetics and a bunch of other things like that. Credit default swaps, all this other stuff like that. It's kind of like owning a option, whatever heck option you want to do. It's kind of like owning, hey, instead of owning physical assets like treasuries, those banks in 2008, they didn't hold that stuff. They held these CDOs, all these other instruments that were essentially like holding an option on a company that went bankrupt. So they're useless. Those options expire useless. That's kind of what they had. So they couldn't have even done this even if they wanted to, because what they owned was useless or worthless. It was worth nothing. That's kind of the situation. That's why, a lot of the laws came in. It's like, hey, you can't own a bunch of crazy stuff like that could go, back to zero quickly. You have to own investment grade bonds. You have to own government bonds. You have to hold your cash as a bank in that type of instrument. So that way there isn't the possibility of, hey, even if we could save you, you don't have anything worth anything. Like I hate to say you're worthless, but that was the reality was, gosh, there was people that looked at buying some of those banks and they didn't want to own the banks because they didn't even have assets that were worth anything in the first place, much less enough assets that were worth enough to actually make all the depositors whole. And so in this scenario right here with SVB today, they did actually own enough securities, enough deposits to actually make almost everyone whole. They just needed a bridge to get there. So to me, this actually made sense in the first place. I'm actually a little bit surprised there wasn't something to kind of facilitate that in the meantime. I like the fact that there's basically in the guidelines, they're going to fire management, all these other things like that. It's really, really nice. So in this particular case, it made sense to make depositors whole. There's no reason to just make depositors not whole when there's actually assets there to get those depositors whole. Honestly, in the end, it's a question of timing is what all this is. So you call it bailout, you call it whatever you want. That's sensational hype stuff that gets, all people fired up and all that sort of stuff. The reality is, let's say they took the bank over or they did take the bank over, bank goes into receivership, bank goes under. What's the next step? You pay out everybody the $250,000 maximum first, and then you start selling off the assets. as they started selling off the assets, at least according to the accounting that we've seen so far, there was enough there to make almost everybody whole. So in the end, almost everybody would have been made whole through this whole process. It just would have taken a few months to sell everything. So basically, it's just a matter of timing. Does everybody get made whole tomorrow or today? Or do they get made whole in 2 months? Now, that makes a difference. Now, maybe bottom line, the difference is zero, right? Everybody, let's just say in the end, they were able to, sell off all the different assets and get everybody back to whole or close to whole or whatever the case is. Maybe it's just the top tier ones, just everybody takes a, 2% haircut or whatever the case is to take care of everybody else. But assuming they can maybe find a buyer out there that may be willing to pay a little bit more with a little bit of a tax break or something else of that nature, whatever it ends up being, the point is everybody's made whole. Is it worth having businesses potentially cash flow strapped going under because they can't get access to their cash for a couple months, or other businesses just not being able to invest for a couple of months, or individuals just not having access and that stress for a couple of months? Maybe they had some business dealings that were going on that now they can't do because now their cash is held up. Is it worth all of those potential domino type effects to waiting 2 months when they're going to get paid out anyways, versus just going ahead and paying them out now so that way the system continue to function as normal? And in the meantime, we'll take care of everything in the background to make sure we get this loan paid off, and we'll move. In the end, it ends up being a wash for everyone. So that, to me, I kind of see the other side of when you have assets that can actually take care of the problem. It doesn't make a lot of sense. All you're doing is making the problem worse by making everybody wait the 2 or 3 months. Now, that doesn't make clickable headlines, right? That's boring. That's, oh, the bank failed, everybody's out all their money, and then not realizing, oh, you know what, the government would have sold off all these little pieces anyways and probably made everybody whole over the course of the next few months. That doesn't make for nearly as flashy of a headline, and neither does, oh my gosh, they're bailing them out. Look, they're just helping out all the rich folks and all the blah, 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 all the other narratives that go around and such. And that's not actually true either. It's the one that makes the most sense in regards to creating stability in the actual banking sector and in the economy as a whole. And when you have this type of scenario, it makes sense to do. Other type scenarios, like what we had in 2008, where the bank got crazy and owned a bunch of useless stuff, at that stage, it doesn't make sense. Sorry, it sucks for those depositors. I agree. I'm not saying it's right or wrong. We can have that debate in a different discussion, but it doesn't make sense in that particular scenario. So this is kind of a unique thing. It kind of makes sense to me. If you have quality assets, hey, we're going to come in, we're going to take you over, everybody's cleared out, and we're going to make everybody whole. And we're going to move this on, either whether it gets bought, kind of like you saw somebody else bought it for $1. They're buying all the obligations and all the liabilities and this loan and everything else along with all that sort of stuff. So it's not like you and I could have paid $1 and then, hey, we could run this. It's like, no. You got to have the capital to actually be able to carry this thing all the way through and such, and the ability to perform the functions that are there. So, that's we're kind of seeing in real time here, the process, this new process of how this happens when you have a bank, essentially go under. And this is kind of also a very good test for how has everything changed from 2008. And so far, the results are very positive. Now we'll see, there's still more stuff to go. I agree. It's early. Again, I don't like making more reactionary type videos like this. However, this was new. This made sense. And the rule was out there. And so I wanted to make sure we kind of talked about it here, because everything I had read so far this morning was, they can read the statement just like I can, but they chose to kind of cherry pick certain things and certain narratives and just run with it. And I kind of wanted to make sure you guys have a more grounded look at that as we kind of move forward. So if you want to see all my buy and sell alerts, my watch list with price targets, basically, take 5 courses for free on exactly how to take care of your money and then implement the system that I use in order to buy stocks, and a whole host of, I got hundreds of videos on there, tutorials, stuff like that, and have access to our Discord group full of 6- and 7-figure investors, and have access to that super secret something that's coming at a little bit of a discounted price. Make sure you check out the pinned comment down there and see everything that you get and see if it's right for you. And click this video here to see the 3 stocks that I'm buying now, and click here to see exactly my plan for this market now. So thanks for watching, and we'll see you in the next one.